Good morning, traders. Today is Sunday, June 12th, and what a wild week last week. Let's start here with the S&P chart and kind of get into it. Remember last week and over the past couple of weeks, I've been trying to highlight let me go to a weekly chart here. Trying to highlight the extended downturn in the market, which I thought would likely move into some sort of retracement around this 420 or 4200 level on the SPY or on the SES, 420 on the SPY. And it looks like the CPI number may have done it. Now we still have this critical low here, this 382 level at 3800 in the ES that we have to be aware of. And you can see this is played out across the NQ chart as well. And if we take a look here, you can see the NQ chart has come down even further, but we still have these lows. Let me draw a line right here. We still have these lows to contend with, which, as you can see, I've drawn this circle that appears to be what I think is going to be a downside support target level. And I'll scrunch this a little bit and show you we have this support level right in here that looks like it may be a really solid target level for the end of a move. So what I'm going to tell you right now is that we're seeing weakness in the market. The CPI data kind of shocked the global markets. Everybody's expecting, at least what I'm reading, is everybody's expecting the Fed to make some sort of an aggressive move to try to stop inflation or to dent it. But what I'm also reading is that consumers have pulled away. You're starting to see some very real contraction in the economy, in spending. I talked to a lot of people out here in California in real estate and retail, shopping markets, and others. And I'm going to tell you that there's been a decided change in how people are spending. People are now protecting capital and protecting assets, expecting for some sort of a contagion event to come into play. And because of this, like I said, the Fed needs to really readjust its, in my opinion, its action. It needs to move at 1/4%, maybe 1/2%, nothing more than that. Even 0.5% would probably be fairly disastrous. The Fed would be, in my opinion, best to move 1/4 of a rate, basis points higher, 1/4 of a point higher, and let the markets continue to unwind. If we take a look here at let me go to the SPY here real quick. Might be a cleaner chart, a little bit cleaner. Let's go to monthly. And what we're going to do here, ladies and gentlemen, is we're going to take a look over here. Let's try SSO. What I want is a fairly clean chart. Okay, this was something I drew a while back, so we'll get rid of these lines. And I want you to understand this is the SSO monthly chart. And what I'm expecting is this 2015 level. I've been highlighting this for many months and many, pretty much all of last year and most of this year. And then this middle area around COVID, I will draw it right around this 2018 base level. So this pretty much is my expectation for target support. We have a lot of support up in this area that I'm not focused on right now, and I can explain those to you later on other charts. But ideally, these become very critical support levels. You can see the COVID low came back into this 2015 low area. If the Fed gets overly aggressive and really starts to raise rates, then I do expect something to be fairly aggressive and move back to one of these two levels. If the Fed does not and starts to stabilize price action, then we could be looking at something moving through, hypothetically, this level and potentially up into this level. Right here, giving us a very clear picture that the end of the move for this downside retracement, if the Fed starts to act in a little more calmer manner, may be somewhere in this area. Let me try to get this in the right area. Perfect. And I just need to drag it down, right? Possibly in this area. So this puts us in an area right around these COVID highs, right into this area here, where we could be looking for some support. And that reflects basically a continued, this is the SSO, a continued downtrend of maybe 16, 17, 18%. This would be a massive move down, okay? And this would probably happen only if the Fed stays very aggressive and tries to move rates quite a bit higher. If we find some support in this area, then we could see this whole move try to roll into a sideways recovery phase, maybe lasting more than 6 to 12 months. It could last even as long as 2 years if the Fed were to try to let the markets unwind on their own, then possibly eventually unwinding even further. So we have a very interesting scenario setting up right now, and that is, will the Fed come out and aggressively try to burst inflation with a half a point or a three-quarter of a point rate increase? Or will the Fed move more decidedly and more with more finesse, in the sense of moving a quarter point, trying to let the markets unwind a little bit, and they may unwind another 6 or 7 or 10% lower, possibly into this area. And a good way to look at it is we've had a move here. Let me see if I can get my mouse to cooperate. And then if I duplicate this, we've had almost the exact same move here. And if we were to have another move here from these highs right here, you can see it puts us right down into my expected target area, right down into these lows. And that's kind of where I think we could go if the Fed is aggressive. Otherwise, we're going to be looking to find some support up in here with a very mild wave 5 move, and then potentially a rally starting a recovery phase for however long it takes. So we saw a big move in gold and silver on Friday. That's capital moving into metals as fear. We're likely going to start to see a big move in bonds. Let me come down and take a look at TLT. We may start moving back into bonds here. This is the weekly chart of bonds. We only hold a 10% position right now. Bonds should be acting as a safe haven. Capital will move into safety as fear starts to escalate, which is why bonds could start to really move higher. We're looking right now for confirmation of that move to safety. We don't have it yet. The real move to safety right now appears to be in metals and miners. So here's an example. Here's SILJ, starting to see some real big upward movement in SILJ. That's silver miners. Here's Nugget, which is the 2X gold miners bull. We're starting to get some real solid confirmation of a bottom, a real started basing right here. Here is GDXJ, which is starting to really form a good solid base. Looks like we're starting to see some real fear moving in. And as you can see, gold is holding up at 1875. This is a daily chart. You can see all my lines. You can see the cycle formation here. We need to basically get above this 1920, 1950 area. And all of a sudden, a lot of focus is going to come back into gold. Silver's moving. It's just under 22 bucks right now. It started a brand new cycle phase. You can see it here, the red line. Let me see if I can make it a little darker. Red line's probably this one. There we go. And you can see we've started a brand new cycle phase. These cycle phases typically mark about 11 to 15% increase. As we get closer to this big fear phase that's coming up as the Fed makes the move, we could see metals really start to rally, especially over the next 12 months or so. So I'm expecting silver to move back up into this $25, $26 range, form some sort of a base, and then as it rolls over here, we might see a little bit of a stalling. This is back into September, but I think it's poised for a very big move to the upside. You can see if I come over here and take a look at monthly, you can see that silver has had these massive rallies. This was in the 80s. This was in 2011. You can see here that we're in a, there's my cycles. We're in a very solid basing formation right now. You can see where we're at right here. We've come up off of these lows. We're basing. We've pulled back. Look at this. It looks like it's almost a perfect retracement. It is. It's what is that? A 0.382, 0.50, and then the 618 is down here. So it's a completed 50% retracement. It's bottoming off of this 50% retracement. We'll see how this plays out long term. But overall, the next move, if this were to happen, would be from roughly here to here, and we would duplicate it to move it up to the current levels, and that would put us at about $39 an ounce for silver. Same thing with gold. You take the same move. I think it looks like I've done it already. Last week I probably tried to show this to you. This is the shorter move here. So we will remove these. And we will duplicate this. And from these lows, that puts us up to 2,600 gold. So that gives you an example of where we're at in the broader cycle of things. Gold and silver look like very good opportunities for us going forward. Okay, so let's go through the basic chart systems. Right now, nothing has changed with regards to our trend following. Longer term, the NQ, the NASDAQ, the S&P, the YM, the industrial average, transportation, SPY are all bullish. Gold is bullish on, oh, sorry, this is the wrong one, May 8th. Let me go get the right one. Thought that was the right one. There we go, and there, oh, it looks like I need to update. So let's just go through it this way. The gauge, yep, I should have edited it. The gauge for this week is short term, we're moderate. Daily, we've got some moderate weakness on the daily basis, short term basis. Longer term, we're still very bullish. Stocks were in 10%. We may look for some opportunities over the next 60 or 90 days in stocks, but we're not going to jump into this thing right away. Cash, we're still at 65%. Metals, we're in 25%. This is our safety, safe haven play. Bonds, we're at 10%. We're waiting for a bottom. We'll start putting some more capital into bonds when bonds actually show a solid trend. Alternate investments were 10% stocks, 85% cash, 5% bonds. CPI data really kind of shocked the markets this week, yet I think it was a reactionary move to the higher inflation, with people expecting the Fed to try to raise rates. We need to basically ride this out, stay patient, see what the Fed's going to do. I know everybody thinks the Fed's going to raise rates by 0.5 percentage point or 3/4. I think the Fed would be smart to move by 1/4, let the markets unwind in a more natural format, and really just let the markets do their thing. The capital function, as I call it, the process of capital moving away and trying to avoid risks, takes place naturally, and it's starting to take place much more aggressively right now after these recent rate hikes. And I think basically the Fed should keep some momentum into that process to unwind inflation, but I don't think they should burst the bubble or blow a hole in the bottom of our ship. So now let's come back over to here, the custom indexes. This is the US to global market index. US market is collapsing much harder than the global market, as you can see here. We're in a downward trend. I think that the US market reverts downward. The global markets stay relatively stable, potentially setting up some sort of a potential bottom. Remember, we have all the global central banks operating in unison to try to destroy inflation. So it's not just the Fed. We have global markets in China, in Europe, in Asia, in Russia, in South America, Africa. All of these are working in unison to try to battle what is a global inflationary event after COVID. And you can see this rally here after COVID that took place. It really started off back over here, 2017, 18, then stalled. Then all the money printing took place and low interest rates in COVID. This was the stalling of the US Fed and others trying to curve quantitative easing. Then COVID hit and everything went into super excessive quantitative easing. Now we've seen this big rally phase again. Everything is back up near these massive peaks in early 2021. You can see that everything's rolled back over into these moderate levels. Now the US market is still elevated. You see where the US market is over here compared to where it was back over here? The global markets have already unwound and they're pretty much hanging out down here near these 2018-19 lows. Could still go lower on a washout low, but the US market has a ways to go. The difference between the US market and the global market right now is a lot of money is pouring into the US market as the US dollar is strong, the US economy is strong, and it's perceived to continue to stay that way while global markets are unwinding excess capital and excess debt. Okay, next we have the custom global asset index. This one shows us that you can see we've rolled over. We're not seeing a big unwinding of global assets right now. Everything is staying price-wise, everything is staying relatively elevated. It is below this level. It is starting to move downward. We are below this 2 standard deviation channel. Honestly, this is the lowest, the deepest type of contraction we've seen, other than, from this area down to this area is about the same type of contraction historically. These types of rotations since quantitative easing started back here in 2009 and 10 have only lasted about a year and a half before the Fed rolls into some other form of quantitative easing, which is why I'm saying the Fed could move into some sort of a more mild stance here over the next 6 to 8 months. We'll see how the markets move. But long and short of it, ladies and gentlemen, we're not seeing a huge unwinding of global assets like we saw back in 2007 and 8, where we saw these big collapses. And I've done some research on that. I'll try to share some things with you. This is my depreciationary cycle phase for gold. This is about a month old, about 3 weeks old. Still looking for gold to really start to accelerate here. This is the gold cycle index updated yesterday. Gold is starting to move off of this nice bottom here. You can see we're getting a good hook in the RSI indicator. And you can see gold is flagging out up here. The next move should be a good solid rally up above 2200, just waiting for this to build some momentum, get back above 4550. And you can see these moves kind of like right here. It based, we came down, we based, look at this. It came down, based, gold actually moved up during this downward cycle in my custom gold cycle index, based out, flagged out. As soon as we started to build some upward momentum above 50, gold started to really begin to rally. That's where we're going to be here. Now, it might be more like 44, 45 that gold really starts to rally here. Gold is primed. Gold and silver is really primed for a huge move. So we'll see how it plays out. Real estate market conditions, same as last week. We don't have any new data to share. Sometimes the data comes on Monday or Tuesday. You can see here we've got reduction counts are rising, active listings are rising. This is active listing count. Number of days on market are slightly rising. This is the reduction share is at the highest level we've seen over the last 7+ years, and prices are still extremely elevated. So even though we're seeing home prices come down a bit, overall year over year house prices are still extremely expensive. This is going to change dramatically depending on what the Fed does. Even a 1/4% rate increase or a 0.5% rate increase would send interest rates up to about 6.25. That's going to be a big shock for the markets, and it's going to take some time, but it will unwind very effectively on its own. The Consumer Engagement Index, this is for June. This is a monthly chart. This is for May. You can see we had a big unwinding in consumer activity. I expect it to continue. Because we had such a big unwinding in May, I expect consumers to to continue to unwind and move to safety, but I don't expect it to break these lows unless there's some major contagion event. So be aware that we're going to see more continued unwinding, possibly down into these levels, which will put us down into the 2012-13 levels for consumer activity, which again, think of that as a leading indicator, like the transports. It's a leading indicator of what consumers are actually going to be spending on and what they're actually going to be doing. And that means that if consumers are pulling away from the economy, then asset prices will continue to drop. That's the only way that it works. Okay, the tech ratio index is starting to potentially form a little bottom. This was as of last week. It was very, very flat. You can see we're down in the 2015 range already. I'm going to warn you to be cautious of tech. It's going to be very, very volatile. We could still see a deeper washout low, but we are seeing some support hold up right now. We just are not seeing any real buy signal. So understand that this is a good sign that a bottom may be starting to set up, but we don't have any confirmation yet. So we can't jump into anything. This is a global market comparison, and it's a little older. Let me make sure I've gone through everything. Okay, that is the global market collapse. Next, we are going to go to the indexes. This is the Fangs Index. This is a good example of showing us what technology is really about. Technology has come back down here to a 50% retracement from this range. Very clean. We can see last week, even though technology did move lower last week, it did not break these lower lows. It could be attempting to bottom in a sideways pattern here. We've got extreme selling taking place here. If we break these lows again, we're going to be looking at a deeper move, potentially back down into this COVID area. So a little bit above these highs here, back into this range in September around the election. And that could happen very easily. Look at the range here. We draw that same range down here, and that puts us right about here, takes us right back over to these lows right before the election. So understand that we're staying away from pretty much everything except if it is miners, metals, or a raw material like energy. Those are still some good plays in my opinion, although I will warn you about gold or about oil and natural gas. As the Fed starts making these moves, we could be seeing a very volatile move. So if you're in oil or silver or natural gas or any other energy sectors long, this would be a great time to the pull the profits out of these trades, scale down some of these positions. Even though everybody believes oil and natural gas and energy is going to continue to skyrocket, if you know anything about 2008, 2009, you're going to realize that it peaked and dumped within a couple of months very quickly. Okay, this is the U.S. stock market index. We're holding up near support. You can see we're bouncing near this 382 level. We got to see what happens here. We're in a downtrend. We've got a downward move, an A, B, C move. If this continues down lower, it's going to move back down into this area, which again puts us back into this September 2021 range and the COVID highs. So really, if we get the U.S. market reverting, like I was showing you on the U.S. to global market index, a reversion is going to end up back down here in these 2019 levels, back in this area. And it's going to basically wipe out another 12 to 15% in the U.S. equities. So we need to be aware of this. We don't want to be chasing bottoms right now until we have some sort of confirmation. The smart cash index, which is more of a global index, has really, this is really the foreign market. Think of this as excluding US, even though there is US in here. We're looking at potentially basing already below COVID levels, already near 2018 lows, actually been already at 2018 lows. It's consolidating in this range. This is likely to try to consolidate down near this base area, maybe get a little lower, but build a base. Whereas the US market index, which we looked at earlier, may still have another 15 or 16% downside to try to form a base down in this, let's call it 900 to 950 area, maybe a little higher. So we have a bit of downside left in the US market. Okay, gold, the metals index, nice and strong move last week, even though it doesn't show it here. We had a good solid rally on Friday. lots of attention moving back into gold. We're down near these low cycles. We need to see this continue to move higher. We need to see this get above 440 here. This would be closer to 1920, 1950 in gold, probably closer to 23, 24 in silver. Once we get up above this 440 level with some real solid volume, I think we're going to go back up to these areas and set up new highs. So gold right now is a great investment. If and again, I'm not going to tell you what to do here, but if you wanted to take a small portion of your residual capital, 5, 10, 15%, move them into some miners. I think this is a good idea, a good time to get involved in a very small seed position in miners going forward. I think this is down near the lows. I think we're looking at a big move, and understand that would be something you'd hold on to for 24 to 36 plus months to let this really expand out and complete the cycle. Next, we have the valuations index broke very strongly to the downside. I've been warning that I thought we were going to get down into this area, 2018-19 area. We could break that threshold right over here around 65, 64, start moving down into this lower threshold area. This tells us that essentially sellers are still driving the trend in the US stock market, and we are back into downward trending. So understand that we are eliminating this excess. This is the excess phase from COVID. You can see it started before COVID. We had a bit of an excess bubble with Bitcoin and everything else. It blew up early 2020. It contracted into early 2021, had a bit of a rebound throughout most of 2021. This was, call it late stage speculation trying to kick back in. Everybody wanted it to go back up. And now we're seeing severe valuation deceleration, meaning everybody may want it to go back up, but everybody's very fearful about what's coming next. Okay, next is the commodity to gold index. This is a great example of how commodities have really unwound and how consumers are just not engaging like they were back over here. This was Flipper Central. Everybody was engaging in speculation. GameStop, AMC, meme stocks. Can't go wrong. Just buy something, it'll go up. Now we're seeing, okay, what do we do? What do we do? What do we do? How do we protect? And this is where I'm trying to tell you, staying in cash and being properly hedged right now is very solid. We are very close to early COVID lows with regards to commodity to gold index, excluding energy, obviously. So we're going to be looking for this to continue to contract as the Fed tries to slow down inflation. Okay, the volatility index is showing us that the market's really losing momentum. So you can see we had this high here, and now we have this high way down here. I'm going to warn you that below 6 here, I'm going to start saying that we are in a deeper potential contagion type downward trend. Right now, this is showing very diminished bullish support for the market. It is still trying to base. It's still trying to bottom. It's looking for some sort of a bottom, but it has very little upward momentum right now. And this is being shown right here in this 789 area for the volatility index. So again, heads up, we could come down, have a washout low, faking people into what looks like a deeper low, and then try to move higher if the Fed or something breaks as far as a bottom, or we could move into some new contagion event, seeing potentially a 15 or 20 or 25% downward move. So right now it's really as we've been doing. Remember, I got everybody into this cash position, back in January, February, actually last year. I got you into it in October, November, telling you that we need to move to cash. We need to sell out our profits. We need to be very, very cautious. This is coming. This move is coming. And now we've seen it. That was way back over here. We were trying to sell out while the market was still peaking. At this point, we're best to play it very safe, sit on cash, stay properly hedged, and wait for this volatility event to really take place. It's either going to be down and try to find some support and then break up, or it's going to be down, try to find some support, and then continue to break down lower. So we need to just wait this out. Okay, that's my longer term. So now let's come back over here, here, and let's take a look at these charts. We'll start with the ES. is still bullish weekly, bearish daily. You can see the sell-off last week. We need to kind of hold these levels, see what happens around these levels here, everyone. And remember, we're not too far away from the COVID highs. So what I'm going to try to do is draw this line here across these COVID highs on the SP, if I can get my mouse to cooperate, and understand that we're not really that far away. So we've got 38 to 33. So it's to take a 500-point move in the S&P or the ES to come down to the COVID highs. On the NASDAQ, we are still bullish weekly, bearish daily. And from the COVID highs, if we come down to these levels, we would be looking at 11,941 to 998, so I call it 99, 11,9, so about a 300-point move, if I'm doing my math right. A 1,300-point move in the NASDAQ would take us down to the COVID highs. NASDAQ as of Friday was down 410 points. So imagine that's 2 days worth of downward trending. And then we're in back to COVID high area. It doesn't take much, folks. We just need to be aware of where the downside risk is. The YM, the Dow Jones, is bullish weekly, bearish daily. We are, looks like, already very, very close to COVID highs. There's our COVID highs. We've got 31,300 to 29,500. So I'm trying to do my math. That would be about 2,000 points. And the Dow was down 825 on Friday, or the YM was. So understand that that's basically 2 days of downward activity, and we could blow through these COVID highs. Now, once we get past these COVID highs, the reason I'm mentioning this to you is this is going to be a big psychological level. Once we get below these COVID highs, then the markets are going to be looking at all of this past price activity to try to find support. And that means we open up this level, we open up down here, this level, this level, this level, and this level really was the 2015 roughly level back here. So you can see that was a 2015 high. So if we get through this COVID high area here, it opens up all of these lower targets all the way back to 2015, where we could see a much deeper correction. So pay attention to this COVID high. Technically, this is a very important psychological level. Okay, gold. Gold is bullish weekly, bearish daily. Looks like it's about ready to turn here. Could be a very strong sign for gold to move higher. Silver is bullish weekly, still pink, bearish daily, needs to move up quite a bit higher. Like I said, I'm looking for the $23 to $24 range to be the next target in silver. Silver is a great opportunity, by the way, down here. It's just a matter of waiting for it, everybody. Crude oil was below 120 on Friday for a while. You can see the 120 level I've drawn here. I really do think that this unwinding process is taking place in silver, in crude oil, and that we could see a pretty big deflationary trend. I'll show you this on another chart. But again, watch this 120 area. If we get below this 120 area and potentially get below this 110 area eventually, then consider oil really losing a lot of momentum. We would be looking at that point, I would be looking at that point for a broader unwinding in the energy cycle, which is why you need to be cautious of trying to get into something here near the energy cycle. If the Fed bursts the inflation bubble like they did in 2008, 2009, then energy, oil demand is going to decrease. People are going to figure things out. They're going to have to pay other expenses, potentially losing their jobs and or getting laid off, which we're already seeing. So be aware. The Fed needs to be very cautious here, kind of unwind this without bursting the bubble. Natural gas has already come down quite a bit. Natural gas is bullish weekly and daily. You can see this big volatility. It looks a lot like this and this and this. We're still in an uptrend. So, I mean, there is some potential here for natural gas and everything to move higher. We don't have any indication that there's a breakdown in trend yet. Like I'm telling you, I'm just saying that I think that we are You know, we're well beyond these peaks way back here in 2013, 14. This was the peak in 2008 and 9. We may see something like this. This is a $10, $12 natural gas, for $13, $14 natural gas, but this is nosebleed, folks. This is like upper bleachers at a concert way in the back. This happens, but you need to be prepared to get out when it's up here. So I think we're very close to nosebleed section. And I think if you're holding out for the rest of this, get your sell orders staged in here, and be prepared to move when it gets there very, very quickly. Don't wait for it and then try to make a decision. Say if you've got, I don't know, if you're holding 1,000 of these things as far as UNG or whatever, then, get your orders set up efficiently to be able to get out of this on some sort of a spike. Otherwise, be very cautious of a rollover back below, say 660, 680. That would be a very good indication that this trend has lost enough momentum that we're pretty well done. And again, this was a great move from down here at $1.60, $1.40 up to 8.50. That's a big seven bagger. That's a big move. Okay, financial sector. Still think financial sector's got some potential. It did roll down. We're down here near these COVID areas again. We only have about $2 to go before we hit the COVID levels. Um, Obviously, it's in a downtrend, so we're not looking for anything yet. You can see the trend lines I've drawn here, these blue trend lines showing historically from 2012 all the way up where there's very solid support. So we're back into that support area right now. We need to be patient. We basically need to look for these opportunities here and see what happens. I'll be honest with you, US banks are probably one of the best currently suited financially institutions on the planet, in the sense that they have backstops, they have reserves, they have ways to deal with things much better than 2008, 2009. SPY bullish weekly, bearish daily. You could see the big selling we had here could end up filling this gap on Monday, Tuesday. Long and short of it, like I said, keep an eye out for this COVID high here, that area, which is in this area here that I've drawn, and understand that there are still some severe risks to the downside depending on what the Fed does. It ultimately, ladies and gentlemen, these 2015 levels are really, really important. They carry over to the COVID lows. They carry over to critical support right now. So understand that if we were to see some major breakdown, we would be looking at, and I apologize, I'm on a stone tablet countertop right now. We'd be looking at about a 46% decrease, which would be similar to the 2008, 2009 level if we were to see a really big breakdown in the markets. But in reality, we have all of these levels. Let me see if I can do this again, which are, call it 26% down here to mid-COVID, 13% to the top of COVID, and where we're at right now, maybe another 2 to 4% down if we hold at these levels over here. So it really depends on what the Fed's going to do. IWM, the Russell 2000. Russell 2000 is already bounced off of the top COVID levels and pre-COVID levels. You can see the Russell 2000 is already showing some support here. We'll see what happens around these levels. This is what I was telling you. Becomes a very critical level. And then this 2015 peak and trough, which is basically this area, coincides with COVID, becomes another very important area for us. So we're looking at the US markets, at least the Russell 2000, attempting to find support right now. Very early stage support. Think of it as looking to find a floor. IYT, the Transportation Index. IYT is bullish weekly, bearish daily. It is almost breaking below recent lows. Now, the Transportation Index is important because the Transportation Index leads the economy by about 4 to 6 months. So obviously, if we get a breakdown from these levels, we'll draw the COVID highs right over here. I have to bear with me with my mouse here, and we're going to draw these lows right here. So understand that if we get a breakdown in this level, that I would think that the next major level for support is going to be right in this area. And that is because we've had all of this pre-COVID channeling. And so understand that this is kind of a normalized price activity going through 2019. If we get below this level and see the transportation index collapse, you can rest assured that the US economy is expecting weaker end of 2022 and early 2023 economic activity. But I'm going to tell you that again, these levels around the 174 to 193, these levels right in here are really important to see what happens. We may see this just wash out a little bit and then start to move back up and then try to find support and then try to move higher. Okay, I think we've covered just about everything. Let's go to real estate real quick. Real estate took a dive. You can see we're at new lows here, which is important. I've been telling you this for quite a while. We are seeing the real estate index really start to move downward. We're already below COVID highs right here. And that's a very telling indicator that we are seeing unwinding take place. We are a ways away from my mid 2015 COVID area, but we've got very clear rejection back over here. This is a very solid price rejection of these highs back over here. I would expect this to continue to move lower, continue to wash out, maybe do exactly as I suggested here. I was a little low on my expectations here. It happened right up here where we saw this roll up and then roll over. I'm about 2-3 weeks too early in my line. But at this point, yeah, the 82 to $87 area looks like a very solid target, which should put us somewhere probably right in this area. And this would become a fairly critical level for IYR in the terms that this is early support level. It reaches back here to this 2020 election basing, and we'd have to see what happens. So this is going to represent a 90 to 80, so about a 16% contraction in the IYR. Now that means, I'm going to tell you right now, my estimation is if real estate contracts in the stock market, we are going to be looking at 10 to 20% contraction in housing market prices. We're already seeing 10 to 14% contraction in certain housing market prices, but it's coming, folks. Be prepared that the house price, the overvalued house prices are going to contract. Some areas more than others. Some areas could see a 50, 60% contraction. Other areas only maybe 10 or 20. But it's going to happen. And depending on what the Fed does, if the Fed is, I don't want to call it stupid, let's just say if they're blind to the risks that are taking place right now and raise by another half a percentage point or 3/4 of a percentage point, that's going to send a big shockwave through the economy. Okay, I'm going to get all of this up for you guys. We are still waiting. Remember, we're going to basically follow this guideline. Right now, we're hedged in metals. We're only 10% stocks if you have any. And the only reason I'm saying that we have some stocks is some of you may want to hold on to your Nvidia or your Google or your IBM or Microsoft. And I do believe the split in Amazon and the pending split in others is a very good move. For example, technology is still going to be around. It's still going to make money. It's still going to show earnings. There is no reason for us to completely empty out of a position right now when we can take a 10% or 15% risk and turn it into a 1 or 1.5 or even less, a 0.4, 0.5% risk by just simply reducing our allocation in stocks. We're sitting on a huge amount of cash. We're sitting on a decent hedging in metals. And now we're just waiting for the opportunity to get back into it. So we're good. If you're running off this alternate allocation level, you're setting 85% cash, 5% bonds, 10% stocks. You have been for many, many months. You missed this huge correction. So understand that, on the NASDAQ, let me come back up here to the NASDAQ or just go to the QQQ. Understand that, we're in an area here where I had you out of risk way before this peak. So this 30% downside move that's taken place for everybody who was trying to buy and hold and didn't allocate properly, this reflected to you if you were properly diversified as a potential 3%, maybe a 1.5, maybe a 1, maybe a 0.6 or a 0.4% risk, depending on how you had your capital allocated. If you followed my rule here, 10% stocks, 85% cash, 5% bonds, and we're diversified in say 5 or 10 stocks, then this 30% move would be diversified across 5 or 10 separate stocks. That means that this would be a 3% times 0.1 or a 0.3% drawdown on your account. It really wouldn't be anything major. Most other people have already taken a 30% potential drawdown. You would have only had a 0.3 or 0.4% drawdown if you had followed my advice and stayed with me through the long run. Now, we're not jumping into anything. We're waiting. This will eventually do something like this, flowing sideways and then trying to move higher, or we'll come down and do a washout and then try to move higher. Ultimately, as I can show you back over here, sorry, that's Windows 11. Ultimately over here, I think I did it on the NQ, we are looking at a wave 5 move. So we are looking at probably the SPY. Yep, this looks like it. Ultimately, we are looking at a wave 5 move kind of like this. We have a base up to wave 1, down to wave 2. Again, that's the 2015-16 range. That's why it's so important. Up to wave 3. So this counts as wave 3. We're going A, B, C, D, E up here to wave 3, down to wave 4, which may end up ending here, and then up to potentially wave 5 way up here. That's why we're looking at this as an opportunity. And now understand it, the markets can still rally in a depreciation or deflationary cycle phase. The reason why markets can still rally is very simple. I call it the shiniest pile of poop theory. Why would so much capital want to pour into the US stocks and the US markets compared to foreign markets like China, Asia, Europe, whatever? It's because of the strength and the stability of the US dollar, the US economy, and the depth of the US economy, as well as the fact that the US has been preparing after the global financial crisis for a major event like this for the last 10 or 12 years. So where would all of this newfound $14 trillion worth of global capital or more want to run to in the event of a global unwinding of excess credit, debt, and liability? It's going to want to run into the safest, most secure asset on the planet, trying to avoid downside risks that are occurring in other areas. And guess what, folks? That's the US stock market, and that's the US dollar, and that's obviously gold and silver. So here we go. This is where we're at right now. We're in this wave 4 correction, and we're getting ready to try to find a bottom and look for this next opportunity higher, which means we'll jump in, we'll get back into stocks, we'll get back into the greatest performing sectors, and we'll still properly hedge with gold and silver, because gold and silver are, where's my index? Where's my gold and silver index? Okay, I'll have to find it. Here it is. The gold and silver index is looking to be a very solid move to the upside off of this bottom. I mean, historic. I'm going to just tell you right now, this is a historic low. Gold and silver potentially could rally in excess of 70. Gold could be above 7,500 in a heartbeat, really in a heartbeat. It could be above 13 or $14,000 an ounce, maybe even more on an extended trend 4 or 5 years from now. Now, when we get into the gold cycle right here, I showed you this earlier. This shows you the rally that took place in 2000, between 2002 and 2011. This was the precursor to where we're at right now. And this is the rally that's going to take place potentially over the next 4 or 5 years. In reality, ladies and gentlemen, this could go on well into 2030, 2031, 2032. And this is to keep things rational. I could have drawn this all the way up to 13, 14,000 if I wanted to because of the cycle, the amount of fear that's involved in the market right now. When this really starts to take off, I'm telling you, these numbers, they could be 6, 7, 8 times where they're at right now, which puts us at $15,000, $16,000 gold. And how am I able to come up with these numbers? It's very, very simple. So this rally here took place from about $270 up to almost 2,000. Okay, so that's almost a 10 times rally. Here we have the same scenario here from about 1,200, let's call it, up 10 times puts us at about 12,000 to 14,000. But we have 3 to 4 times the amount of money in the global economy right now as we did back in this time. So that's why there's more momentum, more fuel to consume the necessary fear for gold than there has ever been in the global economy. And never have we seen a big move. This move was incredible back here. This was the end of the gold standard. And it was an incredible move, a 950% move in gold. And now we had a 750, 780% move here. I think we're looking at a 1,300, 1,400% move here to the upside. I mean, I think it's really incredible. All right, I'm going to leave it here. I'll do some more special update videos as we go, but this has been a very long video, 52 minutes. Great for you guys to stick with me. Follow me on YouTube, follow me on Twitter. I'm telling you, this is just starting. We've got 6 or 7 years or more ahead of us that's going to be incredible. All right, talk to you later.